Hello traders, welcome to the video. In this video, I'll be showing you how you can use divergence to scalp the boom and crash market. So this strategy I'm about to show you works on the boom and crash 1000, 900, 300, 500, 600. It works on all the boom and crash market. But when trading the 600, 500 and 300, you only focus on cashing just 5 candles. But when you are trading the boom and crash 1000 and 900, you focus on only cashing 10 candles. This is the 1 minute time frame and this is boom 900. Don't worry, I will show you an example also in the boom and crash 1000. Down here I have just 2 indicators. I have the MACD, which is the moving average convergence divergence, and then we have the relative strength index, which is the RSI. For those who don't understand what is divergence, let me quickly do a quick introduction about that. Divergence means when we are comparing two markets together, or indicators and market. But here we are using the indicators and market, we compare it together to make our analysis. Let's say in the bull market, we see market generate higher highs. So in the indicator, we're supposed to see it also go higher. But when we see it go lower, so this is telling us that market is likely to change trend to the downside. The opposite of what you see is for the downtrend. So let's say market is coming down, the indicator over here or other market that we use in correlation to it should also be coming down. But once you see the market or indicator going in an uptrend, then we know that this is a divergence. The market, which is this one, may likely to continue in an uptrend. Hope you understand what I'm saying. So don't worry, once I show you examples on the chart, we understand better. So what do we want to see? We want to see a spike to the upside. So for the bull market, we focus in the upper side of the candles. So we want to see market generating highs, and then out of these 4 highs that you see over here, we want to focus on only 2. So these 2 we want to see generate a high and a low in the RSI. So you see over here, this is this high. If I take my 2, this high and this high, which is, so you focus your attention more on this red line over here. So you can see over here, high, high, low, low. So this one is normal market price action condition. But if you come over here, you will see that this is a high, higher high, a high, and a low. This is confirming to you that market is likely to go down. Immediately you have that, then you wait for the cross of the 2 indicators, which is the blue and the red. If you look carefully around this point, this is the candle that causes the cross. Then you will enter a sell immediately and count 10 candles. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You see how market delivers the 10 candle. So let me go back on my chart and show you more examples. So you can see over here, this is also another one. This is happening in the same day. If you look carefully over here, 28. This is the first one, which is also 28. We see market generate high and higher high. And here we see market generate high and low. So we take our 2 and mark out these 2 levels going upside. This one is going downside. Like I said, you want to see the cross of the red and the blue. So you have the cross around this point. You enter a sell and you count your 10 candles. Don't forget, this is boom 900, where we count 10 candles. So let's go to the boom and crash 1000 and let me show you examples also over there. Boom 1000. Over here, high, higher high. If I take my 2 so that you will see it clearly, you see that it is facing upside. And over here, it is facing downside. So you wait for the cross of the red and the blue. You have the cross around this point. You enter a sell and count your 10 candles. You see how market delivers 10 candles. Don't forget, this is boom 1000. So here, because you see this high and a low, you don't just take it. You are looking for 2 spikes that follow each other only. So here we have a low, low, high, high, low, low, high, and a high. So here you have no trade. You're only looking for a spike, 2 spike that is following each other to take your entry. So this is another one. We have a invisible spike around this point. This is a high, this is a high, and on this spike, this is a low, and this is a higher high. So you will take your 2, mark out the level, and also here you mark out the level. So you wait for the cross of the blue and the red. You count your 10 candles. You see how market delivers it also at this point. Here also is a clean one. If you look carefully, high, high, higher high, and a low. So once you have that, you take your 2 and mark out the levels. Also here. So if you see over here, we already have the cross over here. The blue is already at the top of the red. So once you have that, you can enter your sell immediately. So let's say you see the high here, but it is not up to this high, but it has already crossed at this point. Then you will enter a sell and count your 10 candles. So this is example of a condition where you sell without a cross. The reason to this is that there has been a cross before it touches that level. So now let me show you 1 or 2 examples in the crash market and also explain to you how you can use it. This is crash 1000. So here, like I said, in the bull market, we are focusing on the upper spike. Here we are focusing on the lower spike because the crash market is spiking to the downside. So over here is a very good example. We have a low and a lower low, and this place we have a low and a high. So if I take my 2, and also here. So for those who are doubting that, let me just use this to mark it out. This is the spike. This is the second spike. You can see that this is higher than this one. So this one is telling you that the market is likely to change trend, while this one is telling you that it is coming down. So you see over here, the red is below the blue. So you want to have a cross. So once you have a cross around this point, here, then you enter a buy, and then you count your 10 candles. You see how market delivers your 10 candles. So now let me show you settings to my indicator. First thing we do is to click on this indicator icon over here. I said I have just 2 indicators. I have the relative strength index and the MACD. To select the relative strength index, click on the F icon on the main chart. Scroll down, relative strength index, RSI. Click on that. Make your period to be 150. Apply to open, style, 2 pixel, and select color of your choice. For the levels, click on this pen icon. Add level. Type 85 and 15. Style, make it 2 pixel, and select color of your choice. After that, click on save. For the MACD, click on the F icon on indicators Windows 1. Scroll down, MACD. Make your fast EMA to be 12, slow EMA to be 26, MACD SMA to be 9. Apply to close. Styles, make it 2 pixel and 3 pixel. Select color of your choice. After that, click on save. So for the zoom level, let's say this is the enamel zoom. So you zoom in 3 times. 1, 2, 3. So the zoom level did not really matter as long as you are dealing with divergence. After this, I want you to go back on your chart, backtest this strategy, and test it with your demo account in a live moving market. Test it for at least 2 to 3 weeks, compare your win rate, and then try and balance your entry, because this strategy is a bit technical. If you don't pay close attention to the chart, you will not be able to trade it. If you find this video helpful, don't forget to like this video, subscribe to this YouTube channel, turn on the notification bell so that you get notified anytime I release a new video. You can also check out my other videos that are displaying right now on your screen. Thanks for watching.